All right, good afternoon. I assume that everybody can hear me okay. And welcome to our 90-minute aviation presentation presented by Forvis Mazars and sponsored by JetLinks. Our speakers today are Katie Simmons, the firm's leader of the private aircraft aviation, the services division here at Forvis Mazars. John Buchanan, a manager at the firm's private aircraft services division, and we're quite happy to say the former leader of aviation matters nationally for the Internal Revenue Service. My name is Robert Davis, a partner in the firm's private aircraft services division and a member of NBAA's tax committee and the chair of the committee's tax advocacy working group. Our contact information will be presented at the end of the presentation, so you might want to be ready to screenshot some of that. But enough of the formalities. It's an exciting day. Let's get on with the presentation. That begins with Katie telling us about what you should expect over the next 90 minutes. So take it away, Katie.
All right. Thank you, Robert. And thank you to JetLinks for having us. We're excited to present to everyone today. So on the agenda for today, we're going to start with understanding the team that's really involved when you've got an aircraft transaction, understanding who the players are, what their role is, and ultimately creating a successful purchase and an ongoing mission. Next, we will dive into the income tax implications of any personal or entertainment use of an aircraft. Then we'll get to the exciting stuff, bonus depreciation. So that's been a very hot topic around our office. Robert will discuss the One Big Beautiful Bill Act rules, how those apply, and what you need to do to make sure you can take advantage of that. I will be discussing some of the additional provisions in the tax code that we need to be aware of. So if we jump through all the hoops to qualify for bonus depreciation, what are some other traps that may prevent us from actually being able to take that deduction? We'll also touch on sales and use tax and property tax related to aircrafts. Obviously, these are expensive assets, so they come with big sales tax and big property tax bills. So we'll talk about some strategies to sort of mitigate that. And then lastly, we'll talk about the audit landscape. So the IRS has a campaign currently focused on business aircraft, and John will be talking about how you should be preparing for that. All right, so let's talk about the team that it takes to get an acquisition done successfully. So first of all, we need to be aware of who all of our stakeholders are. So we've got a lot of regulatory agencies that are going to be invested in our aircraft. The first and most important is, of course, the FAA. So the FAA's job is safety, and the federal aviation regulations are very strict and very black and white, and aircraft owners really need to understand how their aircraft fits within those regulations and what they need to be doing to comply with those. In addition, after we think about the FAA and keeping them happy first and foremost, we've also got the IRS and state and local tax agencies who are focused on revenue collection. So how do we have our aircraft owners comply with all those tax rules, but also not pay more than they should? And so we'll be talking through some of those strategies today. What's really key when you're thinking about these three different regulators is they all have their own set of rules, and they don't follow each other's rules. So when we're thinking about structuring, we really have to find this one magic sweet spot that checks all the boxes and accomplishes our goals. And it's really not a one-size-fits-all strategy. Understanding how a taxpayer is going to be using an aircraft, what their goals are, helps us sort of find that one set of rules that'll work together and make for a successful transaction. So when you're thinking about getting into private aviation, we've got tons of different options on the table, right? So the first thing that we want to understand is, what is the mission? Who's going to be using the aircraft? How are they going to be using it? Where are they going to be going? Who's going to be on board? Um, and then from there, finding a solution that's going to accomplish as many of those goals as we can. So, of course, you have whole ownership, which comes with a lot of benefits like control. But it also can come with downsides. There's additional administrative work when we're thinking about all the regulatory rules we need to comply with. There's also risk that, we could have a problem with our aircraft and it could be out of service. So, when you're weighing the options, there's pros and cons to everything. When you've got fractional or chartering, the administrative work can be a lot simpler, but the cost may be higher. So as you're sort of thinking about what your need is, finding the product that's going to fit your needs is really important. All right, so once you've kind of defined what you want and what your goals are, that's where we start to develop the team. So who should be involved externally? We always recommend getting an aviation attorney to help you, especially if you've got a whole ownership situation. As I mentioned earlier, the FAA rules are very complex, and you want to make sure that you've got the appropriate documents in place, that you've been properly educated on what the agreements mean, what all of your parties involved need to be doing, so that we don't inadvertently violate any of those FAA rules. Of course, you also need an aviation accountant, someone who can help you not only find a structure that's going to maximize your tax savings, but also comply on an ongoing basis, so that if you're ever audited, you are prepared and there's nothing to be scared of. In addition, you also want to make sure you have your tax preparer involved. So understanding, the particular nuance of your tax situation is really important as we're thinking about structure, because we don't want to create a structure where we think we're going to be able to get a benefit, and then one of these other code sections that we'll talk about later ultimately causes us a problem. If you're financing, it's important to have your lender involved in conversations, your broker, your insurance company. You also want to make sure your management company or your charter company is also on the same page and understands how you're going to be using the aircraft. It's best to sort of have everybody as a group working together, and we like to quarterback that for our clients so we can make sure everyone knows the plan and can stick to it. All right, so internally, it's also really important to make sure you've got the right players at the table. So of course, you want your legal department involved. They understand your corporate structure, what your future may look like, and can sort of help us navigate how we apply all these rules to your particular circumstances. You obviously want your tax department involved, whether that's internal or an external firm, so that ultimately when returns are getting prepared, they have a clear understanding of how this should be reported, and are taking advantage of any special rules that may benefit you. If you've got security for your high-level executives, that can come into play as we're thinking about personal use of an aircraft, which John will talk about later. Getting the accounting team involved is really important. So one thing that we see a lot, and we'll touch on it in a little bit, is just the accounting team not understanding why we have a certain structure in place, and they, try to create efficiencies that ultimately cause us some problems in terms of violating the FAA's rules. We also want to think about who our primary users of the aircraft are going to be. So whether it's shareholders, executives, board of directors, who's going to be using that aircraft? How are we going to navigate conflicts when multiple people have a need for it at the same time? Do these people understand what the impacts to them personally are for any personal use of the airplane? This is where an aircraft use policy can be really helpful, just sort of laying out how we're going to use this aircraft in our organization, how we're going to navigate any of those challenges. And then lastly, public relations can also come into play. So if you've got, a purchase of an aircraft, maybe we want to be thoughtful about how much information is available to the public about that. Do we need to sort of message it correctly? Do we need to create a structure that's going to give us some anonymity and prevent people from being able to go on ADSB and see our location? Maybe we're doing a lot of M&A work and we want to keep that private. All those considerations, again, are going to come into play. And to have a successful operation, we need to make sure everybody understands. All right, so we see lots of different types of private aviation operation models. What we typically see is an operating company that has a need for an aircraft, and it purchases the aircraft or holds the aircraft in an LLC that it wholly owns. With that structure, these are the most prime for potentially FAA issues. And where that typically happens is if you've got a large corporate structure and you've got intercompany charges and different entities within the organization using the aircraft, it's really important that we prepare our reimbursement structure so that they comply. And we'll talk more about that. But, we see a lot of third-party charter use as well as aircraft owners chartering their aircraft to supplement costs. We also see dry leasing to third parties. Those come with some tax implications that you need to be aware of. Another one that we see commonly is time sharing and interchange agreements. Again, those need to comply with the FAA's rules, but they also have excise tax implications. And so if this is something that you're considering, again, it's important to involve your attorney, involve your CPA so you can make sure everything's up to snub. All right, so reimbursements. As I mentioned earlier, this is really the most common issue we see with clients in terms of Part 91 issues. So the IRS has this concept of a disregarded entity, but in the eyes of the FAA, there's no such thing. Even if it's your airplane and your company, and it's all you at the end of the day, the FAA doesn't see it that way. So we need to look really closely at the rules and understand that each entity is going to stand on its own. So when we've got a client who wants to do some type of reimbursement or cost sharing arrangement, whether it's executives reimbursing the company for personal use of the aircraft, or maybe related entities using the aircraft for their own business activities, wanting to reimburse or do from type transactions for airplane costs. Sometimes it even can be unrelated companies. We see this a lot where, someone will have a friend and maybe their airplane is down for maintenance and they need to go somewhere. And they say, oh, you can use my airplane, no problem, just pay me back for it. All of those reimbursement arrangements, if they're not done properly, can inadvertently violate the FAA's Part 91 rules. And so we've got to make sure we've got a good plan in place to deal with those. What we typically find is that not planning ahead and not involving the parties that should be involved is when we see these issues come about. And even if you've got the best of intentions with your reimbursement arrangement, it can lead to really negative outcomes if we don't do it properly. So we can have pilots losing licenses, fines from the FAA, and then potentially the denial of insurance coverage, God forbid anything happen. All right, so I'm going to turn it over to John, who's going to tell us a little bit about the implications of personal and entertainment use of an aircraft.
Okay, thank you very much, Katie. All right, as you went through with Katie, now you have your organizational structure all set up. You got your leases in place. You got your team members, your internal and external team members all set up. You're ready to fly, right? Well, before you do that, let's talk about some of how you're going to navigate the tax rules coming up that you need to know about it for these flights you're going to be taking. We're going to, on this next section, we're going to talk about some of the disallowance rules for entertainment and non-entertainment, and we're going to talk about the income inclusion because you don't get away from that with using your aircraft. So we're going to talk about both of those in this next section. When we talk about use of an aircraft and navigating the tax rules, there are three big sections of the code you're going to have to be aware of that you do calculations for. And those are the expense disallowance, the income inclusion, and qualified business use. To pass the qualified business use, to be able to claim the bonus and accelerated depreciation, which Robert will go over here in just a little bit. There are a lot of other code sections that affect usage of an aircraft that you got to be aware of, and Katie will go over those with you later also, so you'll be aware of them. So as this slide shows, the entertainment and income inclusion affects any type of ownership, whether you own the aircraft entirely, full ownership, whether you just own a fractional share of an aircraft, whether you're leasing fractional share of an aircraft. Jet card usage, that's one that we're seeing more and more of. But even you have a jet card usage, the expense disallowance and income inclusions apply to that. If you have a third party, someone's chartering your aircraft, a third party's chartering your aircraft, or you're chartering someone else's aircraft, these rules affect those ownership. And as Katie was just talking about, interchange and timeshare agreements, you got to be aware of those also. And if you have any of those, you want to make sure you set those up correctly, just to make sure you're on board, you're on top of any interchange and timeshare usage. Okay, next slide. So when we're looking at the rules, there are two main structures that are utilized by the IRS that they look at. One is an employer-employee relationship, right? So that's what we're going to focus the discussion on today is employer-employee relationships. And then you also have what they call the primary purpose aircraft rules. This is a Schedule C that's reported on a 1040. That's a whole nother topic. That won't be covered in this presentation today. So in today's presentation, we're just going to talk about employer and employee relationships and that structure. All right, Katie, next slide, please. Excuse me. So the first we're going to talk about is income inclusion. Whenever you use an aircraft and you have a personal trip, or you take a personal passenger with you on a business trip, you're now subject to income inclusion for personal use of that aircraft. That's a taxable fringe benefit to the individual passenger. So as we go down through the slide, the first section here, we're going to talk about what does that mean, right? And how do we value that personal use of the aircraft? So it's applied at the passenger level, certain exceptions of that, but mainly applied at the passenger level. And the way you want to value that personal use is using what we call the SIFL or Standard Industry Fare Level rules. The SIFL rate, and we'll talk about the other rates later, is the most favorable, and that's the one you want to use to value your taxable fringe benefit for personal use of that aircraft. There's a lot to this SIFL rate. There's a lot of nuances as we'll go over here. There's a lot to doing the calculation itself on using the CIFL rate. So there are differences between, as you see on when we do the computations, you're going to need to know who the control employees are, who the non-control employees are. What's the maximum certified takeoff weight of the aircraft? The multiplication that's factor is based on the maximum takeoff weight. So the lighter the aircraft, the lower the multiplier you're going to have, and the lower the CIFL rate will be. The number of seats occupied by crew available for takeoff. We'll talk about that in a minute. The miles between the origin and destination for each flight leg. IRS uses statute miles when they do the CIFL computations. Going to need to know the related party rules, and definitely Robert will definitely be getting into that here in a little bit under QBU. Reimbursements. Did any reimbursements occur for personal use of the passengers? Katie mentioned reimbursements a little earlier, but you definitely want, when it comes down to CIFL and reimbursements, basically what you're doing, if a employee reimburses for personal use of a flight, you still got to do the CIFL calculation to make sure they reimburse at least the CIFL amount for that flight. The imputed income, this non-taxable fringe benefit, you reported on K1, mainly for your partnerships, 1120S, right, or W2, 1120S, 1120s, or 1099 NEC, depending on what the circumstance is there. And there are two reporting periods you can do for CIFL reporting. One is the typical calendar year, January to December. And then there's also an election you can do where you can do a November 1st, or you can cut off on October 31st. So your reporting is November 1st of the prior year to October 31st of your current year. And they allow that. So you have time to do the reporting, get it included in the W-2 and reported to the 1040 individual, so they can report it on their return. So they allow you to have this cutoff, which is very nice. All right, next slide, Katie. Some additional rules for CIFL. Personal use passengers under the age of 2. So if your passengers under 2, don't have to worry about including CIFL for them. So get your family trips in early before they get too old. Because, if you have kids, the older they get, the more they cost you, right? So it goes true for aircraft also. Flights that involve personal and business legs, so if you have one leg's personal, next leg's business, there are ways you take that into consideration and compute the CIFL for those. Mileage computations for when the aircraft stops for weather, customs, mechanical. They're not going to ding you for CIFL inclusion if you have these types of stops. So there's computations you do to when we look at CIFL and you have weather, customs, or mechanical stops. Personal use of by passengers when 50% or more of the seats available for passengers are occupied by business use. What do we mean by that? So let's say you have an aircraft that has 8 seats. And so say 6 of the seats are business and 2 are personal, right? So you have more than 50% of the seats that are available are occupied by business passengers. So in that case, if it's a non-control employee, there's no CIFL charge for that. But if it's a control employee, you get the non-control employee multiplier to use if this 50% seat capacity rules kicks in, and also the dependent children and spouse of the control employee don't get CIFLed. So we definitely want to keep track of the number of seats and whether those seats are business or personal, because you could get some relief from CIFL if you have more than 50% business seats, occupied business seats, right? Passengers flying with security requirements. A lot of times you get a security study and you have you got to fly with you're flying because of security reasons. You have the security on board with you. You get a lower multiplier, reduced multiplier if you're flying for security reasons and you have that security study done. You got to have the security study. So make sure if you go if you want to use this for help to reduce CIFL, you got to get the security study done. That's mandatory. International travel for more than 7 days involving personal use and business use. One thing I want to tell you on this, if you have international travel for more than 7 days, there's a lot involved in that, more than just the CIFL computation. There's a lot of rules involved with international travel, especially when you have personal and business use. So you want to get help with those type of trips. Make sure you understand those rules. There is a lot involved with that. Deadhead flights, repositioning flights. Those are flights where they're flying empty, right? You're not going to get hit with CIFL charge for any deadhead flights. So CIFL does not apply to deadhead or repositioning flights. So that's the basic rule. So you can see there's a lot to the CIFL computation. CIFL has to be elected and reported on your original filed return. So if you don't report on your original filed return, you basically can't use CIFL. You got to use one of the alternative methods to value the personal use. And the first one is a charter rate. What's the fair value charter rate for that trip from point A to point B? That's what the taxable fringe benefit would be. And I can tell you the CIFL rate is extremely lower than the fair charter rate. So you always want to use the fair charter, you always want to use CIFL when you can, because that fair charter rate will be higher. I don't know, Robert and Kate, I've never seen it lower, the fair charter rate. I don't know if you guys ever have, but I've never seen it lower.
You have a
You'll see
lot of passengers, it can happen.
Yeah.
But generally, CIFL is going to be a better deal.
Yeah.
That's exactly what I was going to say, John. You can have a fully loaded personal use aircraft and sometimes have the charter rate be less, but I can't cherry pick that. I've got to pick what I'm using in a tax return and not cherry pick each flight individually.
Yeah, that's a good point, Robert. You have to use one method for the whole year. You can't intermix the methods in a year. So if you use CIFL, you got to use that for all flights. Use charter rate, you got to use that for all flights. Another one is the lease valuation method. It's when crew are not provided with the aircraft. So what's the fair, like a dry lease? What's the fair dry lease value? So with the IRS, if you don't use the CIFL calculation and you get audited, IRS is going to, and if you didn't, IRS is going to come in and charge you the fair charter value rate. They have ways to get those rates, and that's what you will be hit with upon audit if you haven't used CIFL. They'll use the fair charter rate for all your personal trips.
Hey,
All
John,
right.
let me ask you a question that we get a lot.
Yeah,
Do you have to report CIFL for your dog?
for you. Yeah, we do get that. And I have, that's kind of funny because I have seen that on audits where they've included dog as passenger. No, even if the dog's 200 pounds, you still don't have to include that dog.
Only human beings. Okay.
Only humans, only two-legged humans. You get, yes, you have to, you have to include. That's funny. I have seen that on audits on flight logs. It's like, wow, okay. So that's the income inclusion, the fringe benefit income inclusion rules. Next, let's talk about the expense disallowance. This is where you get tripped up a lot, and we're going to talk about documentation towards the end of the presentation. But when we're talking about expense disallowance, we look at it on an individual passenger level. What do I mean by that? You got to look at what the purpose was for each passenger on board each leg of each trip. So that's what we mean by it's applied at the individual passenger level. The results are aggregated to arrive at a disallowance applied against all aircraft related expenses. So you're basically looking at the entire year's flights to come up with your disallowance percentage, and it's applied to all aircraft expenses. And when we mean by all, we mean everything. It's operating and non-operating. Non-operating like depreciation, insurance, interest, and also all your operating costs, maintenance, pilots, fuel, everything is included in the disallowance percentage. How do you come up with this percentage? Well, for non-schedule Cs, they give you 4 methods to be able to come up with your disallowance percentage: occupied seat hours and miles, and flight by flight hours and miles. And just to give you an example what those mean, let's say we have 1,000-mile trip, 1 flight hour. This is Robert flying because he flies pretty fast. and you have 5 passengers on board that flight, right? So with occupied seat hours, you take the number of passengers, 5, times the hour, which is 1. So you got 5 occupied seat hours. So each passenger is allocated 1 hour. So let's say on those 5 passengers, you have 3 business and 2 personal. When we do our expense disallowance, we're going to have 3 hours for business and 2 hours for personal. And you use that same methodology for if you do flight by flight miles. The occupied seat, or I'm sorry, the flight by flight method is you're going to take that 1,000 miles or that 1 hour and divide it by the 5 passengers. So we have a 1,000-mile flight. For flight by flight method, we divide that by 5 passengers. Each passenger is allocated 200 miles, so to speak. And so in our scenario with 3 business and 2 personal of a 1,000-mile flight by flight, you're going to have 600 miles allocated to business, 400 allocated to personal. And you kind of think, well, shouldn't it all come out the same, right? You're like, we're looking at this, why wouldn't the percentages pretty much come out the same? No, they do not. And you think about it, for occupied seat, if you had a personal trip that was cross country or even say over to Europe and it was full, you had all personal passengers and it was full. Well, that occupied seat, you're taking, let's say it was a 10-passenger aircraft. You're taking those 10 passengers times the miles for that trip or the hours for that trip to come up with occupied seat. Whereas with flight by flight, you're just taking the 1,000 miles in this case, or the 1 hour, and you're allocating it to business and personal. So you can see where when you're doing occupied seat and you have a long trip with a lot of personal passengers, that can skew the disallowance as opposed to comparing it to flight by flight. And I've seen the computations come out vastly different on some of them, like big percentages. So you definitely want to compute all 4 methods each year. So you make sure you're always picking the lowest disallowance percentage for your situation that year, for your flights in that year. You're allowed to change the method from year to year. So each year you're allowed to pick the lowest method and use that on your tax return. There's no rule that once you use like occupied seat, you have to continue to use that. You can change your method year to year. It's like it says there on the slide, you can cherry pick. Yeah, we're going to take the lowest method each year. But one thing you got to be aware of, if you have more than 1 aircraft, you have to use the same method for every aircraft in your fleet. So you can't use different methods for each aircraft. You got to use one method for all your aircraft. Okay, next slide, please, Katie. Some additional rules for when we talk about expense disallowance. Ghosting passengers on deadhead flights. What do we mean by that? Well, if you have a deadhead flight, you have to allocate that. So what flight does that deadhead pertain to? That deadhead will then take on the character, being the purpose, and the number of passengers that flight pertains to. So if I had a deadhead flight coming in to pick me up in Pittsburgh, and my wife and I flew on a personal trip to Hawaii, then that deadhead flight takes on 2 personal entertainment passengers, is how we will account for that deadhead trip in the expense disallowance. Maintenance and training flights, they get allocated over all flights. They're not just automatically business. They get allocated between all categories of flights. Aggregating costs, so if you have more than 1 aircraft, you can aggregate them into one expense disallowance calculation if they are similar per the Treasury Reg rules. They have similar cost profiles, same number of engines, propulsion types, etc. So you want to look at that. If they're not similar, you have to keep track of the expenses separate, and you have to do an expense allocation for each aircraft. Costs related to third-party charter and dry lease operations for fair market value payment for services. And then the next thing is a very, very beneficial election that the regs give us is the straight line election. So you can elect to use a straight line for expense disallowance as opposed to bonus. So let's say, just to say in 2025, you bought a $10 million aircraft. You had 29% expense disallowance percentage, right? So if you took 100% bonus on that $10 million aircraft, you can either disallow 29% for expense disallowance, or you can make the election under 274-10 to use the straight line amount. So what would the straight line amount be on that aircraft for year one? And you take the 29% against that straight line amount. And that's just for the expense disallowance. You still get to take that $10 million bonus depreciation, but in your expense disallowance calculation in year one, you're going to take the straight line amount times your 29% expense disallowance. So that's one thing to consider when you're putting these aircraft in service and you want to claim bonus and you have expense disallowance. This is a very beneficial election you want to look into. All right, and next slide. Thank you. So this slide just gives you some of the classifications and whether there's income and expense rules there. So let's just go down this real quick. So if we have a business trip, is it deductible? Absolutely. Is there any income inclusion to the passengers? No. Right? It's a business trip. A business entertainment trip. This is where it's a business trip. You take, like, Roberts has his business and he's flying over to take me out golfing. Well, so we might talk a little business, but it's an entertainment type trip. Is it deductible? No. After TCJA came in place in 2018, entertainment is non-deductible. So if it's a business entertainment trip, you get no deduction for it. And there's no CIFL inclusion or income inclusion because it's a business trip. How about personal non-entertainment? Now you'll see on these next two categories, there's personal non-entertainment and personal entertainment. So personal entertainment is just what it says. It's an entertainment type flight. You're going on vacation, you're going on a hunting trip, you're going skiing, just going to the beach. You're on an entertainment type trip. Whereas a personal non-entertainment trip, it's still personal, but there's no entertainment value. There's, you're going on a medical trip. You got a funeral you're going to. I've had the argument presented to me where, they went to the in-laws for Thanksgiving and they're saying there was absolutely no entertainment going to the in-laws for Thanksgiving. So this should be a non-entertainment trip. And we're like, sorry, that's not going to fly, right? So how the rules work, if it's a non-entertainment trip, it's included in income because it's personal, but you get a full deduction for that trip. If it's an entertainment trip, personal entertainment trip, it's included in income as a fringe benefit, and it's not deductible, but I'm sorry, it is deductible, but only up to the amount included in income. So if that trip, you picked up CIFL of $2,000 and the trip cost $5,000, you get a deduction up to the CIFL amount you included in income, which is $2,000. And the last one here is commuting. It's a personal type flight, so it is included in your income calculation. And is it deductible? No. Again, and TCJA came in and disallowed all commuting trips. So after TCJA in 2018, if you have a commuting flight, it is non-deductible, except if you have a partnership. Partnerships were not included in the disallowance under commuting under 274L. So if you have a partnership, we can help you with, you need to look for help for classifying those trips and how you report them.
But commuting is the worst. It's our double tax. We have to pick up income, and that income that we picked up at the individual level can't offset our expense disallowance. So bad outcome.
It's very bad. And they also expanded the definition of commuting to, it used to be from principal place of business to your principal residence. So now commuting after TCJA is principal place of business to any residence. So if you have more than one residence, commuting from your principal place to any residence is now, any trips from principal place of business to any residence is now considered commuting. So, all right. And I think I'll turn that over to Robert now.
Yeah, thank you, John. So, at any rate, we're going to talk about some exciting depreciation rules. John just touched on them just a second ago with a very beneficial election. But let's just step back for a little second here and take a little broader look at it. So depreciation, and that includes bonus, that's the stuff everybody loves to talk about, applies to new and used aircraft at this point. Okay, that the used aircraft were added a little while back. It was a very beneficial change to the law. The legislative landscape, okay, that exists right now, basically we have the Tax Cuts and Jobs Act that has been superseded in great regard by well, I'm going to call it OB3, okay, just to make it easier to say. So, nonetheless, those bonus depreciation rules under TCJA were in a phase out period, and they still exist under the new law for a period of time. OB3 reinstated the 100% depreciation, which was of great interest to the non commercial aviation community. So, property that's placed in service in 2025 was generally eligible under the TCJA phase-out rules of 40% bonus depreciation. That was in a 20% per year phase-out, or that phase-out was delayed by 1 year for certain aircraft and transportation properties. So that gave us the opportunity for 60% in 2025. OB3, like I said, reinstated the 100% bonus depreciation for property placed in service on or after January 20. And woe be to the poor souls that decided to go to 2025 and closed on January 1 through January 19. So nonetheless, that is the story about the January 20 date. Now, the depreciable lives for aircraft, it really comes in two flavors. Okay, so not 31 flavors like Baskin Robbins. We'll just hold it to two flavors. And it comes in different asset classes. So for purposes of us, we've got the asset classes on here. 00.21 is basically, think about it as Part 91 operations, but it is all helicopters and airplanes that are not used in the commercial carrying of passengers or freight. I've got two depreciation systems involved with that. The general depreciation system, think of that as normal makers, double declining balance, switching to straight line over 5 years. The alternative depreciation system is a straight line methodology over 6 years. Asset class 45, think of this and very generally for today in terms of Part 135 flights, assets used in the commercial and contract carrying of passengers and freight. So the maker's life, the GDS life is 7 years. The ADS life really stretches out there a little bit all the way out to 12 years. So we know that in real life, sometimes the use of airplane across their depreciable lives changes as far as what the predominant use of that aircraft is. You may have somebody that gets into it, oh my gosh, I got me an airplane, let's use it. And then they found out how expensive it was. And then in year 2 or year 3, it's like, man, I got to put this thing on charter in order to supplement some of the expenses with some charter revenue. And if I do that and the predominant use of that aircraft changes, then there's special rules exist because I've changed asset classes midstream and the Treasury regulations guide us through what happens. There are other special rules that exist that require your definitional knowledge of qualified property, what constitutes original use, and what is an acquisition requirement. And we don't have time to talk about all those today because we got some more exciting stuff we're talking about here in just a second. Okay, so the next slide, Katie. So what are our accelerated depreciation methods that are available to us? So we have bonus depreciation. That is the creme de la creme that everybody loves to talk about. Please don't go enter the aircraft business, if you will, because your buddies on the golf course said, oh, you got to get you some of this bonus depreciation, man. You wouldn't believe what it did to my tax bill. Please get an airplane because you need an airplane, not a tax deduction. Okay. So nonetheless, you also have the thing that's been around forever, the expensing election under Section 179. This is less talked about in the aviation space because it does require the measurement and existence of taxable income under these rules in 179 to be able to take the benefit of the 179 deduction. And then finally, the GDS or General Depreciation System lives, generally regarded under Section 168. And those GDS lives are just exactly what I talked about on the last slide, which is 5 years and 7 years. If you are not eligible, okay, for the general depreciation system or other elements of accelerated depreciation, then you're relegated back to the alternative depreciation system, which are those longer lives of 6 and 12 instead of 5 and 7. And it forces a straight line methodology. That's also the lives that are functioning in the rule that John talked about in his last slide. Okay, so the eligibility for all of these depreciation methods that are accelerated under GDS and bonus and various expensing methodologies basically involve you having to pass the qualified business use test under section 280 cap F. Okay, and unfortunately I'm going to have to say that section a whole lot because to use the actual title of the section would be here all day. All right, next slide, Katie. So the 280F listed property rules. Okay, these rules originally came about out there. Oh my gosh, back in the 1984 Tax Act. It had to do originally with things like cell phones. For those of you that are older in the crowd, you had to keep up with every call you made so that you could allocate your cell phone usage on your tax return. Well, airplanes are rolled up in those rules. Thank God cell phones are no longer. Okay, so to be eligible for the accelerated depreciation, I've got to have more than 50% of qualified business use. QBU is the operative term that's utilized and scattered around throughout this code section. Basically, it's the use and the trade or business of the taxpayer. There are some other nuances that's true of just about every slide in this presentation, but that's the basics for today. So, and you may hear it on the first tee at the golf course on Saturday morning. Well, my guy says as long as I get more than 50% use, I'm golden. I can get all the bonus depreciation, so on and so forth. Unfortunately, it's an airplane, and so there are aircraft specific rules, in this case, a 25% test that really controls what's happening on the airplane. Okay, you might think, hey, if I can get past 25, I'm on the way. And I get to 50. Hey, I passed 25 on the way. I'm no math genius, but that looks like that works pretty easy. But the problem is the 25% test excludes certain types of usage as qualifying business use. So, what are they? Any use by 5% shareholders, think of this very broadly as owners. Okay, so it could be partners, that type thing. Parties related to them is defined by the code, and their guest, okay, that's personal in nature. So flights out there by this set of parties, think of it as being SIFLed. Those flights are not QBU in the 25% test. And any personal use by a non-5% shareholder that's personal in nature, and they just didn't get the income imputed to them. Okay, so that has its own problems. Okay, but it also generates this problem inside the QBU 25% test, also the 50% test. In the case of an ownership structure that contains a related party lease, which could be its own course for the next 3 hours, okay, but if you have a related party leasing structure, any use by a 5% shareholder, related party, so on and so forth, it's not QBU. So think about this. Elon Musk called you up and he's waving his wallet. He wants to buy your company. Okay, just get on your airplane and go see him. By gosh, it's a wonderful day. Might be the most important business meeting you've ever had. You getting on that airplane as a 5% owner in a related party lease structure will not count as a business trip for QBU purposes. Okay, this is a very common foot fault in structures, the way they're set up for ownership. Literally, I could have 2 airplanes, same flight log, different structures. One's eligible for accelerated depreciation and one is not because of the related party leasing rules. One thing that helps us is leases between an entity and another one that's disregarded means the lease is disregarded, which takes us out of the related party lease rules, even though the lease is between 2 related parties. But enough about the bad rules for a second. if the 25% QBU rule is passed, then these restrictions, or at least most of them, not the one where you forgot to impute income up there, are removed to compute the final 50% test. Okay. Now, how do you do this? It's the same methodologies that John was talking about. Occupied seat hours, occupied seat miles, flight by flight hours, flight by flight miles, 4 computations. I have to pass one of the 4. Okay, but if I don't pass any of them, the test is failed. I have to switch that aircraft to ADS straight line depreciation, 6 years or 12 years. That testing continues throughout the depreciable life of this aircraft under the ADS life, even if I took all this bonus in year 1 and I didn't have anything else on the tax return. Because if I fail that test in a subsequent year, that depreciation will recapture back to what the ADS depreciation would have been across the life of the aircraft. Next slide, Kate. All right. So you're just like, well, I'll just put it in a lease, and that way I'll be a lessee, and the lessor is going to be in the business of leasing, and so I'm not going to have to fool with this. Well, 280FC1 talks about, hey, if I'm in the business of leasing, then 280F doesn't apply. I'm scot-free. Okay. Well, there's 2 problems there. One, the leasing of a single asset under the Treasury regs, although they use an automobile as an example, is not considered to be in the business of leasing. I think most of us here would say leasing an aircraft is slightly more complicated than leasing an automobile, but the IRS is stuck to their guns on this particular single asset regulation. All right, the other thing is the lessee still has a similar test, 25% and 50%. You're like, well, the lessee doesn't have any depreciation. They don't own the asset. Well, it's a one-time income addition through a complicated set of tables inside the regulations. Once you fail that test, you take the income hit in the year of failure, and you don't have to perform that test anymore. Please understand, though, that if you're testing every year and you've been successful passing it, you are stuck with that testing as a lessee even beyond the ADS depreciable life of the aircraft. Okay, so what's important here? Structure planning. Okay, please do it beforehand. Okay, if you do have a related party lease structure, okay, or you're a lessee and you need to be doing testing, do it like about Q3 of every year if you're wondering where you stand to see if you need to adjust. Okay, next slide. All right, the part that you've been waiting for. Oh my gosh. So what happens here? First of all, you got the warning on the slide. This is tough stuff. Okay, do not go out there and look up the DIY videos on YouTube. Okay, that is not where you want to be to see if you can do what's in these next slides. All right, go ahead. All right, so to quote a movie, so you're saying there's a chance. Okay, so in this case, we're trying to get from that very active space out there during COVID, and immediately after that, the book to build ratios were horrible. You sign a contract for an airplane, and then you go into a holding pattern with an estimated further clearance time of expressed in years in terms of delivery. Okay, so look, many airplanes were contracted for under the TCJA rules that are in their phase out. The scheduled deliveries are under OB3, which has that lovely new 100% rule. Okay. This section explores the possibility of utilizing the OB3 rules, that 100% rule that came about, even considering the fact that the aircraft was contracted for under prior law. Okay, this requires a deep dive into the Treasury regulations. We're going to talk about written binding contracts and self-constructed property and economic performance and what does the IRS think the word incurred means, and so on and so forth. And the way to do this is to logically go through the Treasury regulations, if that's even possible on most days. But let's go ahead and go to the next slide and see if it is possible. Okay. So OB3 says that a property can't be acquired after the date that a written binding contract exists for the purchase. Okay, well, the written binding contract has its own nice set of regulations, but generally enforceable under state law. And we're looking at something that doesn't have a liquidated damages provision that limits those damages to an amount less than 5% of the purchase price in the case of a buyer breach. Now, the Treasury legs don't talk about buyer or seller breach. It just talks about liquidated damages. Logic, to me, dictates that the buyer should not be punished for a seller breach. So that's why I like to call it a buyer breach. I need to have a written binding contract to continue this exercise, this narrow path to OB3 redemption, if you will. So once a written binding contract exists, the Treasury regulations then say that if the property is manufactured, constructed, produced by someone other than the taxpayer, then I'm going to use self-constructed property rules. We don't want you out there building your own airplanes, thank goodness. Okay, I'd rather somebody do it that does it for a living type of thing. But the important part here, look at this next bullet. To keep going, the written binding contract needs to exist. You needed to enter into that contract prior to commencing the manufacture of the airplane. Okay, so if you picked up one that was halfway through the line because somebody else decided to cancel their order, you sort of got a problem here. Okay, so, but to keep going, I've got to be self-constructed property under this written binding contract. Okay, so now, again, we're trying to move this acquisition date to the other side of the law change. Okay, well, when is the acquisition date? Well, it depends on whether I'm an accrual or cash basis taxpayer. This is something your accountant did when you had your initial return for your aircraft owning entity. You selected an accounting method. So in this case, the self-constructed property is the date that this manufacture of more than 10% of the total cost of the asset has been incurred for the accrual basis taxpayer or paid for the cash basis taxpayer. It's a tongue twister. Okay, that 10% that's in that rule, it's a safe harbor rule. It's a nice rule. You can go make up your own rule, but you're going to have to defend it to the IRS. What does incurred mean? Well, incurred then takes you down another path. It happens when economic performance has happened with reference to the purchased airplane. Well, if you're an accrual basis taxpayer, economic performance occurs when the property has been provided to you, which needs to be on January 20th or later in 2025. Okay. So if you've done all that, the accrual basis taxpayer might be able to treat the property as being acquired on the other side of the law change. Okay. So that's your narrow path. There's a lot of ways to get derailed, if you will. And the law is new. Treasury could come around with regulations that says, nah, it doesn't work. But for right now, we believe it does work. Next slide. Finally, oh, look at those capital letters and that red big font. Oh my God, must be important. So nonetheless, we utilized the last slide, and this came up with a tax accounting methodology. It's because we wanted the new law with the better depreciation rules. Well, if you think about going back in time, there were other methodologies that you wanted to keep that old law because the new law wasn't as snazzy in terms of a percentage. If you elected one of those other methodologies to hang back in the old law, okay, when there were other bonus depreciation changes, you established the methodology. You can't do what's on that last slide because that would be changing methods and then you have to ask permission. And I'm just going to take a wild hair and guess and say that would be problematic. Okay. All right. So the aircraft that didn't meet the requirements, what happens? They're still eligible for that 40%, 60% thing that we talked about back in my first slide. Why doesn't it work for a cash basis taxpayer? because that deposit that you paid, that probably more than 10% deposit, okay, probably happened prior to the cutover date. Okay, and remember, it's not incurred, it's paid for a cash basis taxpayer. Why wouldn't a used aircraft be able to take advantage of that last slide? Well, because the airplane was already built. Remember, self-constructed property, that written binding contract has to be entered into prior to the wrenches being turned and the sheet metal being formed for the aircraft. That's the problem that you run into most awfully often for used airplanes. So, nonetheless, that's my section of this. Katie, let's say we get all this, we got this pile of deductions, depreciation, and other stuff. There's a few more hurdles to clear, I believe. Talk to us about them.
Yeah, so you make it down this very narrow path. Do y'all hear that feedback, or is that just me?
I got you.
But
You're good.
let's say you make it down this narrow path, you get to the place where you can take 100% bonus depreciation. Life is wonderful. Well, now you've got a whole nother bunch of code sections that we have to consider. Make sure you ultimately can take that deduction. So what are some of these limiting code sections? So first of all, we have 162 that says that expenses incurred in our trader business need to be ordinary and necessary. So this is when we would be thinking about the mission of the aircraft. If you are just flying in a certain region of the country, you're never going internationally, you don't have many passengers who go with you, and you buy a huge jet, that may not be considered ordinary and necessary in the eyes of the service. So this is something that can come up in audit. Another one that we'll see sometimes is 183. So these are the hobby loss rules. A hobby is generally just going to be considered an activity that's not engaged in for profit. So an activity that continually produces tax losses. There aren't changes being made to generate more income, those sorts of things. Hobby is a really bad outcome if the IRS argues your airplane activity is a hobby. And the reason is any income you generate from that hobby is taxable, but expenses are not deductible. Bad outcome. Another one we've got to think about are the at-risk rules under 465. So this basically says if I'm going to take a deduction, I need to have skin in the game for it. So if I have this big loss as a result of bonus depreciation, do I have some money that I'm at risk to lose, whether it's through debt or capital contributions, things like that. The one that we commonly run into is 469 in the passive activity rules. So just for those who aren't familiar, a passive activity is any activity that a taxpayer does not materially participate in. Rental activities are what we call per se passive activities, meaning if you're renting property, whether it's a home or an aircraft, it's automatically going to be treated as a passive activity. So when we see those structures, the related party lease structures that Robert talks about, where we get the more restrictive 25% test, let's say we do everything, we pass the 25% test, we pass the 50% test, our lessor entity qualifies for bonus depreciation. Well, if that entity is just in the business of leasing, the loss flowing through to those partners are going to be considered passive losses. So this is when we need to consider grouping elections, maybe having a different structure to avoid this rental activity. This also can come up with charter use or third-party leases. So if you're purchasing an aircraft in the fourth quarter and you've got to get it placed in service and you're going to put it on charter, be really mindful of these passive rules because we don't want to tie up a bunch of our depreciation as a passive activity and have some of that bonus depreciation be non-deductible. Another one we'll see sometimes are unreimbursed partner expenses. So say I'm a partner in a partnership, maybe an accounting firm, and I own an airplane and I'm using it to go travel and see clients and go to conferences. That could be considered an unreimbursed partner expense. But to be deductible, our operating agreement needs to have certain language that's going to allow for these expenses. So if this is a structure that you have in mind, it's really critical that you revisit your partnership agreement and make sure you're going to be prepared in an audit. All right, so some other fun ones. 212, this basically says that any expenses related to investment income are itemized, miscellaneous itemized deductions, which under the rules are now non-deductible. So if you've got any expenses related to investment activity, those may be considered non-deductible. So that, again, is bad outcome. Another one that we see come up a lot are employee business expenses. So again, under the rules that originally came out under TCJA and now have been made permanent under OB3, any expenses that an employee incurs and are unreimbursed are non-deductible. This will come up a lot in situations where you've got someone who, built a business over a number of years. An investor comes in, buys them out, but that original owner stays on maybe as a CEO for a certain time period, but they don't have any ownership, or it might be very limited. And so they have this big liquidity event. They go out and buy an airplane and they're going to fly it around for all their business trips. Well, because they're an employee now, none of those expenses are deductible. We can't take any depreciation. So that's when we need to think about an alternative structure to pull some expenses into our tax return. Another thing about that, it's not on the list, but just keep in mind that depreciation, it can offset sometimes capital income. So say you sell your company and you have a big capital gain, and so you go out and buy an airplane and take bonus depreciation to reduce your taxable income. Well, when you ultimately go and sell that airplane, you're going to have recapture to the extent that you receive proceeds on the sale. That recapture is going to be ordinary. So over time, with that strategy, you're ultimately going to pay more in tax. So just another thing to keep in mind if you've got any liquidity events. When you have S corporations, a common thing to think about for financed aircrafts is whether I have basis to take the loss. So the debt basis rules for S corporations are a lot more restrictive than they are for partnerships. So that's something you certainly want to consider. Another one is the limitation on business interest expense. This used to be a bigger issue. OB3 sort of made it less of an issue in the aircraft space, but essentially, if you have interest that's more than 30% of this adjusted taxable income number, your interest expense is going to be limited. Lastly, 461, this is a limitation on excess business losses. So when you get to the individual taxpayer level and we have all these pass-through items coming through from our K1s, and say we have a lot of bonus depreciation, it's driving a loss from all those activities. Well, the amount of that loss is going to be limited, and we're not going to be able to absorb wages or investment income with that loss. It doesn't go away completely. You get to carry forward that loss as an NOL, a net operating loss, to next year. But it is something to keep in mind as you're tax planning. All right, so we will get a break from income taxes for a minute. Sales and use tax and property tax are a huge issue in this space. So a lot of people just, they focus on income tax, but these can have major implications. And with proper planning, you really can mitigate these. So this is, again, why it's really good to be planning ahead. All right, so sales and use tax, they are different, but not the same. So sales tax is the tax that's going to be due to the state where we take delivery of the aircraft. So we purchase an airplane and we want to take delivery in a state that has an exemption that we would qualify for. So we don't have to pay that sales tax to a state that we're just going to leave from. So commonly you'll see what are called flyaway exemptions. So states have certain requirements. Basically, if you are going to base the airplane in that state or only have it in that state for maintenance and repairs or for only a certain time period, you can qualify for that state's flyaway exemption and pay no sales tax on the purchase. Again, this requires planning ahead, making sure you have all your documents in place so that you comply with the rules for the exemption. Some states also just have very low sales tax. So I'm in South Carolina, it's $500. So sometimes people will just take delivery in South Carolina, pay their $500 and call it a day. So that's sales tax. You can plan around sales tax pretty well by finding a state that's got a favorable rate or a favorable exemption. Use tax is the harder thing to plan around. So use tax is going to be the compensating use tax that is due to the state where you're going to base the aircraft. Some states, again, it's really low, like South Carolina, but for most states, it's a percentage and it can be a big number. How do we reduce that number? So one common thing we do is set up a leasing structure. So the entity that owns the aircraft is going to lease it over to our operating company. Our lessor is going to obtain a resale certificate. They're going to collect and remit sales tax on the lease payments that they receive over time. So instead of paying that one big lump sum at the time of purchase, we're going to spread out the tax over the time we own the aircraft. You have to have a fair lease rate. An appraisal can be really handy in a sales tax audit. Some states aren't going to allow this if the lessor and lessee are related parties or part of the same tax return. So understanding each state's specific resale exemption is really important. Other states have other exemptions. For example, airplanes that are used in interstate commerce or for common carriage can have some exemptions. Some states have exclusions based on the amount of use in the state for the first year. So when you're looking at use tax, you really want to understand what your options are and also where you're going to be using the aircraft. You don't want to inadvertently create a use tax liability in a state that maybe you're not primarily based, but you spend a lot of time in. So Florida is a classic example. And this is an issue that the states are really going after. We've been seeing a lot of sales and use tax audits. They can be big revenue raisers for the states. So you want to make sure you've thought about this ahead of time. All right, the other forgotten tax is property tax. So again, a state like mine may have a $500 sales tax, but we have a big property tax in South Carolina. And what's worse about that is it's the gift that keeps on giving. You got to pay it annually. And so this is going to be the property tax related to the jurisdiction that your aircraft is hangared in. They do check, they'll go and write down N numbers and then see if they're on the property tax rolls. So it's important that you register and you pay those sales tax to avoid interest and penalties for noncompliance. There are some things you can do to reduce the property tax burden. For example, if you're in a state and the counties have fairly different rates, maybe you're near a county line and it makes sense to hangar the aircraft in the county over, and you either deadhead it or you just drive up there, but it's worth the property tax savings. Some states allow apportionment that can be based on arrivals or departures or miles flown over the state, days in the state. Again, this is where you want to have your aviation accountant involved so you can see what your options are and not miss an opportunity. All right. So John, as the former subject matter expert with the service, will you tell us what we need to do to be ready for an audit.
Absolutely. Yeah. Thanks, Katie. Yeah, so next let's talk about what we never want to experience or hear, right? A tax examination or tax audit. Unless you were in my former position, then you like to hear tax audits, exam because that was job security back in my former position, right? So you like that word here. Now you don't like it, right? So, where are we going to where are audits going to come from? Where are they going to generate from? You're going to see the IRS, right? That's the big one. That's the one everyone is aware of, knows about. IRS is going to look for the audit on your income tax, federal income tax, also excise taxes that are due or could be due on an aircraft. As Katie just talked about, the State Department, states are ramping up their audits of aircraft use and the sales use tax and the state income tax on an aircraft, and then the county for property taxes. So let's talk about the IRS a little bit. They started in the last administration. Now, the aircraft has always been an issue in the IRS. It's one that's always looked at if it's come across on a return. It's usually always picked up, always looked at, always audited. Prior administration, they started ramping up the exams of aircraft, and that was partly because of the new hires and the divisions that they were staffing was where the aircraft fell. And they also started a campaign. Back in 23, an aircraft campaign was started with the Internal Revenue Service. And what a campaign is they have different campaigns in the IRS, and those are a campaign is they'll have one tax issue or one point of law, and they start a campaign. They pull returns just to look at that tax issue. So in 23, they started a campaign just to look at returns that had an aircraft being reported on it, and they audited that return for the aircraft deductions. So that campaign is ongoing. They started a second wave of returns have been sent out, and they're continuing that campaign today. So that's out there. State and local, they've discovered, that's a high value target, these aircraft, with low effort to make these assessments. So they're going to target those. So there's more audits by the state and by local jurisdictions. Bounty hunters are employed by some jurisdictions. What do we mean by that, right? What we mean is, say you took possession of your aircraft in Florida. You had the flyaway exemption because you live somewhere else. So you took possession, took delivery in Florida, flew it to out of the state to, let's say, Pennsylvania, where you live. But if you fly it back to Florida for whatever reason, like maybe you have a second house down there, or you go down there for an extended period, they have people that called bounty hunters that keep track. So in Florida, if you're there for more than 20 days, you may be subject to additional tax. And they have these bounty hunters that in different states that watch that. So, and the bottom line is, these taxing authorities, IRS, the state, the local, they've discovered that this could be a pot of money for them to go after. So you want to be prepared, right? You want to be ready for it. Anytime any of these authorities contact you, you get that horrible call or that letter in the mail, you want to be ready. So next slide here, please, Katie. So if the IRS contacts you, the first thing they're going to do is give you an information document request, an IDR, and they're going to say, I want this information on your aircraft. And this is the IDR that you're going to get up front. They're going to ask for information on the aircraft. They're going to ask for all your flight logs, where the origin, destination, the miles, the hours for each leg you took in that year. They're going to ask if you have any airframe or engine maintenance logs. They want to know the passengers, and which passengers are specified individuals, which are control employees. They're going to ask you for that. They want to know who the 5% owners are, who the related parties are, and not related parties just related passengers, but related entities that are using that aircraft. They're going to ask for that. This is for the 280F computations that Robert talked about. Flight classifications for each individual passenger. If you remember, we talked about earlier when we did the expense disallowance, they look at each passenger. Each passenger is classified as for expense disallowance. So they're going to ask you for, okay, you had 10 passengers on this flight. What were they on board for, business or personal? What was the reason they were on board? They're going to ask for any dry lease agreements you have in place, any management or charter management agreements, maintenance agreements. Again, timeshare interchange agreements. They're going to ask to look for those. Does your company have a internal use policy for the aircraft? I mean, that's if you don't have one, you might want to look into getting one. That's very that's a good document to have that kind of shows how you're going to be using that aircraft and if you ever get audited. And they're going to ask for your computations that we just went over, your CIFL computation, your expense disallowance, the 280F QBU computations. They're going to ask for your copy of how you computed those numbers. So that's next slide, please. So that's what you're going to get hit when it first start, when you get hit with an audit with the IRS. That's the first thing they're going to ask for, all that information. This next part we're going to talk about is that's what it says. The best defense continues with documentation. I can't stress the importance of keeping the contemporaneous documentation for each business flight and the passengers, because over the years, that's where probably 95% of all the audits I've been involved with have issues with the documentation of the business flights. I have someone keep track of that for you as the year goes on. You have a business flight, get that documentation, file it away somewhere. So if you're ever asked or requested to say, hey, what was this flight for? You say it's business. Where's your documentation? You can just pull it out and you don't have to go back and try to find it again. So when I say documentation, what am I talking about, right? So the IRS is going to ask for, and what's required by law is that you provide contemporaneous documentation that supports the business purpose of that flight. So what we mean by contemporaneous documentation are emails, right? You didn't just hop on a flight and fly from point A to point B without setting something up. And usually this day and age, we're setting it up with emails, right? So do you have an email that you set up at appointment that shows the business purpose? Do you have a calendar invite on your calendar, that shows that'll help substantiate that business purpose? Do you have any presentation materials, marketing materials, business cards, people you met at the party or at the conventions, and that you should have your registration application and your payment. You want to keep that to show that you registered and paid the agendas from those types of events. The contemporaneous logs of the details, like think who, what, when, where, and why, right? So do you have your log? That log should have been kept as you're going, and you mark this stuff in the log. A lot of times you'll see you'll have a flight log in the book, and you'll see the handwritten notes that they did at the time of the flight. Purpose of this flight was visit this client and discuss this contract. And you'll see that in the flight log, and that's huge. That's a good documentation. Meeting agendas, pictures, text. If you keep your text and on your phone and you're texting, setting up a meeting or business purpose of meeting. One of the times I like to say is think outside the box of what you can keep or provide to substantiate that business purpose. I've seen in the past where a company had different locations around the country and, plants, and they went to visit these plants on a routine basis. And we're like, well, how do you substantiate that? And, they didn't really set up emails or anything. They just had this routine. They went. Well, it was very, I thought it was, they came back with the documentation, and I thought this was fantastic in that the employees have to swipe their cards to get into the plant. So when the owner went to visit the plant, he's had to swipe his card to get in. They were able to provide us reports for those card swipes, and those reports corresponded back to the flights on the flight log. So, okay, you went to visit your plant, and that really helped with documentation. Just so think outside the box what you can provide, what you can keep to make sure you document the business purpose of that flight. And remember, it's not just the flight, but for each passenger. So there might be 5 people on board that flight, and you're saying they're all for business. You got to substantiate with the documentation that all 5 people were on board for business, for that business purpose. And as the last point says, the IRS will give you a reasonable extension of time to gather this documentation. And if you ask for a lot too much time, they're going to say, "Sorry, Charlie, you're out of luck." But they will give you a reasonable amount of time to put this information together, this documentation. But if you keep it as the flights occur, you'll be able to pull that right out, and you'll be golden, ready to go.
And one thing I'll mention that we're seeing in exams is there's no sampling. And a lot of times, the first year that gets picked up for audit is the year where bonus depreciation is claimed. But then the service is opening up the next year or the next 2 years. So between those 3 years, you can have hundreds of flights, and it is very challenging to go back and coordinate with lots of different people across your business and gather all the emails and the meeting agendas. And it's a lot of work, and it really distracts from your core business and makes these audits really painful. So to the extent that you can create a system at the beginning for filing this documentation, having it go somewhere you're not going to lose, and have it ready to go in an audit, it will make that whole process a lot less burdensome. So
Absolutely.
well, thank you, John. So in conclusion, we made it to the end. This stuff is very complex, and there's big dollar values involved. You've got to plan ahead. If you don't plan ahead, plan to pay, because you're probably not going to have things set up the best way they could be. And there are people who are here to help. Life is short, buy the jet, and let us help you make sure it's fun and not a painful process. So again, you want to be thinking about all your regulatory issues, your tax issues, your state and local issues, and coming up with a plan that meets all of them and ultimately accomplishes your goals. So we will share our contact information, and I think we'll follow up with an email after this. If you have any questions, please reach out. We love talking about this stuff. We love that every client is different and has a different story and a different solution that works for them. So we are here to help, and many thanks to JetLinks for having us today.
Yeah, and does anybody over at JetLinks want to close out here?
Yeah, I sure will. Appreciate everybody's time today. From our perspective, like you kind of saw how complex these issues are. That is not going anywhere anytime soon. From JetLink's perspective, we've been doing this for 26 years. We are certainly capable of providing the reporting, the tracking, anything and everything that an aircraft owner might need in order to satisfy this, pretty comprehensive list of things to be aware of, and we can help you avoid the traps. We work, day in and day out with our friends at Forvis, with aviation attorneys. This is all part and parcel to the value that we add to aircraft ownership. So appreciate everybody's time, and look forward to hearing from folks on any feedback that they might have, and look forward to working with you all very soon. So thank you.
Thanks so much.
Thanks.
Thank you very much.
Bye.